Hello and welcome to the lecture on forms of business ownership. This covers sections 4.1 through 4.7 in your textbook. So most of the employment in this country, and probably eventually most of the jobs that many of you will hold, are in private business. So I had mentioned earlier in the semester that you're either going to go work for a branch of the government, you're going to go work for a not-for-profit, or you'll work for a business. And this describes how businesses are organized. So it's a particular interest to understand how the business that you're going to work to is organized, or if you're going to start your own business one day, what the options are and what the pros and cons are of each type. So an overview, and then I'll go more deeply into each of them. A sole proprietorship is a single individual person that's operating a business. It could be part-time, it could be what they call a side gig, it could be you work on cars in your garage on the weekend, or you do taxes for somebody, or for example, I will help people, businesses with financial analysis and get paid by the hour to do that. I'm operating as a sole proprietor. Very simple. Partnership is two or more people that work together in the effort to generate a profit. And that could be from informal to very formal. Corporations are legal organizations that stand apart from their owners. They exist as a legal entity. Most people are employed by corporations that work for businesses. And then there are specialized forms I'll talk a little bit at the end: collectives, cooperatives, joint ventures, and franchises. So what this chart shows that I took from the book is that the majority of businesses, if you just look at the number of businesses, are sole proprietorships. There's an awful lot of people doing, like I mentioned before, side gigs, doing business independently. When it comes to revenue, so who generates the most in terms of sales, it would clearly be corporations, 81%. Every organization I worked with until I started teaching was a corporation. So a little bit about sole proprietorships. So sole proprietorship, like as I mentioned before, is a business that's established, owned, and operated by a single person. It's easy to establish. There's no legal requirements. You don't need to get a lawyer involved or anything like that. The only thing you need to do is file for a local business license. So whatever community you live in knows that your business exists. So in a low liability exposure type of business, this could be a fine option. Like for me, doing financial analysis for people, there's no real risk associated with that. But areas where harm could come to somebody or damage could be created, it's not a good idea. And I'll explain why in a minute. So some of the advantages of sole proprietorships: it's easy to form. It doesn't cost much money, just the local business license is all. So it's an easy or a low barrier to entry, easy to get started. All the profits accrue to the owner, so the owner takes all the risk and gets all the reward. There is direct control by the owner, so if you decide that you don't want to do X anymore and you want to start doing Y, you can do that if you choose. There's no separate tax that's paid by the business. So the only tax that's paid is the operations of the business, both revenues and expenses that flow onto your own personal tax return. And then lastly, when you decide to not be in that business anymore, you just close it. No problems. Some of the disadvantages: the first one is the biggest there. No limitation on personal legal liability. That means from a liability perspective, meaning getting sued and having to pay damages, there's no distinction between your business and you personally. So all of your personal assets, maybe you own several vehicles, maybe you have a savings account, maybe later in your life you have a retirement account, all of those things can be taken from you to pay the damages created by your business. Say as an example, you're fixing cars in your garage and you forget to reconnect somebody's brake lines. They leave your house, they drive down the hill and crash into cars. That's your fault. You'll pay for that. And again, that will come out of your personal assets. So that's a big risk. They have a limited life. You can't pass a sole proprietorship onto your children. They have a very limited ability to raise money. If you want to grow your business, buy another location, add machinery, get computers, all of that, the only way to bring money into your business is for you personally to borrow it or contribute it to your business. And then if there are losses, the owner's on the hook for all of those. A partnership is an association of two or more people that agree to operate a business together for profit. So there is a need for a written partnership agreement. It's not a requirement. You could form a partnership informally. Just a couple of you could say, hey, let's get together and do this or that, pool our money and make some money at it. That's a partnership. But it's a really good idea to have a written partnership agreement that covers things like, how do we go about bringing new partners into the business? So how do we break up? Who takes what when we decide not to be partners anymore? How do we split the profits? Is it even, or is there some other kind of an arrangement? And who contributes what to the partnership in terms of maybe assets or work? So all of that being laid out clearly in the partnership agreement is really important to avoid disputes and arguments later. There are two different kinds of partnerships. The most common is general partnerships, and that's what I'll focus on. There are also limited partnerships where not all of the partners have legal risk. That's often done in larger partnerships like CPA firms or law firms. So some of the advantages of partnerships, they're also relatively easy to form. The only thing you really need to do is have that written agreement in place. There is more capital available, so you can invite other people to come into your partnership, and they could have to contribute cash or assets to enter the partnership. You're able to get a synergy. So by being careful about who you select as incoming partners, you can find people that complement each other's skills so that together you are more impactful than you are separately. And then there is no separate tax. So partnerships, their income flows to the tax returns of the owners, of the partners. Now, some of the disadvantages. The first one is really big. No limitation on personal legal liability, just like with a sole proprietorship. So every partner in a general partnership, every partner is legally responsible personally for the liabilities of the partnership. And a kicker, it's joint and several liability. So they are jointly all responsible, but then each individual is responsible. So for the entire partnership's liabilities. So say as an example, you enter a partnership with two other people and it goes horribly wrong and there's a big lawsuit and a big amount to be paid and there's no assets to pay it from in the partnership. So the people that have sued you get a judgment against you and they want to collect. If your other two partners are personally bankrupt and have no funds, you would be on the hook for the entire settlement. It would be up to you then to go after those other two people for their portion of it. So that's a big risk. There is a potential for conflict. It's hard to find people that get along in all cases, that don't have kind of different motivations or different ethics or different values. So there is, it is a situation that is ripe for potential conflict. Mutual agency means in a general partnership, any individual partner can obligate the entire partnership. They can sign a lease, they can borrow money, they can do all kinds of things that cause the other partners to be obligated whether they knew about it or not. So you have to be very careful about who you trust with that ability. And then because you're in effect breaking up, it's more difficult to dissolve. It's harder to end a partnership than it is a sole proprietorship. So corporations, again, that's where most of the sales, where most employment takes place. They are organized under the laws of a particular state, and you can choose to organize your corporation or file articles of incorporation in any state you want to, whether you do business or reside in that state or not. Delaware generally has the most business-friendly corporate laws, and so many businesses will incorporate in Delaware to be protected by those laws. There are actually more corporations registered in Delaware than there are people that live in Delaware. So a corporation can own property, it can enter into contracts, it can sue other people and be sued, it can do all of the things that a person could do with respect to business. So that gives it a life separate from that of its owner. Somebody could start a corporation, they could have ownership interest, they could die, that corporation still continues on. So this is important. Corporations are owned by stockholders or shareholders. Those words mean the same. And in most cases, they have one vote per share. So the person that, and by voting, I mean they can vote for the board of directors, which controls the company. So if somebody owns 51% of the shares of a company, they have control of that company. They could decide if the company is going to get into a new business, sell part of its business, buy a competitor, all of those things. So there's a direct link between shares owned and ability to control the company. So kind of the hierarchy within a corporation, start out with stockholders. They're the ones that use their shares to vote for the board of directors. The board of directors is a small group of people that are in charge with setting the direction for the company and making big high-level decisions like what business should we be in, should we expand, should we contract, all of those kinds of things. The board of directors will hire the top management of the company. So the CEO or chief executive officer or president, they'll hire the chief operating officer, the chief financial officer. There may be other people at that level. It depends on the company. Sometimes there's a chief technology officer, that sort of thing. So those people are hired by the board of directors and they can be fired by the board of directors. So they are answerable to this group that represents the shareholders. Top management will hire middle management. Those are like vice presidents and directors in charge of different aspects of the company. And then middle management will hire supervisory management, people that are actually overseeing work getting done. So some of the advantages of corporations, there is limited liability. That's the key advantage. So there is a separation between the assets and liabilities of the corporation and those of its owners. So if you invest in a corporation, what you are risking is your investment, but nobody is going to be able to come after your personal assets. Those are protected. That's the number one reason that people usually incorporate. It's the number one reason I incorporated when I owned my business. It's relatively easy to transfer ownership. If I have shares in a company, I could choose to sell some of those shares to you. You now have ownership of it, so it makes the ownership increments very portable. It has unlimited life, so it continues on past its owners, and it has a much greater ability to attract capital because they can issue new shares of stock and bring more money into the company. Some of the disadvantages, the big one is double taxation of profits. So what that means is the corporation is going to file a tax return and pay tax. So let's say as an example, our entire class owns a corporation and that corporation has $100,000 in net income. The corporation will file its tax return and it'll pay 21% of that, or $21,000, leaving $79,000 worth of profit in the company. If the company chooses to pay that $79,000 out to the owners as a reward for their ownership, earnings on their investment, that sort of thing, the owners of the company are now also going to pay tax on the dividends they receive. So that portion gets taxed twice. It is more complicated to form a corporation. You generally need to have a lawyer involved in doing that. And there is more government oversight of corporations than there is the other forms of business. Now, a couple of different types of corporations. The most common is a C corporation. It could be publicly traded, meaning you could buy and sell its shares on the stock exchanges like Ford Motor Company, Tesla, Apple. Those companies are all publicly traded. Or it could be privately traded, meaning it's owned by a small group of investors. My company, Big Toys, was a privately traded C corporation. Actually, we were an S corporation, but we were privately traded. So an S corporation is similar to a C corporation in terms of liability protection, but it's taxed like a partnership. So the profits of the S corporation will flow through to the shareholders and they'll pay the tax. So it can avoid that double taxation issue. And then there are not-for-profit corporations. Those are organizations that exist for reasons other than making a profit. Generally, they are 501c3. That's a recognition by the IRS that they are a recognized not-for-profit. That allows you to make tax-deductible donations to that entity. Last, special forms of businesses. There are cooperatives. Those are people that pool together to try to operate as a collective or as a group of people. Ace Hardware is a good example of that. They're all individually owned, but they agree to work together to get discounts on buying larger volumes of products and advertise. Joint ventures, that's where two companies come together to do a specific project, maybe to build a new factory that they're both going to benefit from or something like that. And then franchises are when you purchase the ability to market and sell a product in a particular region. So maybe you buy a Subway franchise that gives you a turnkey kit of all the things you need to do to operate your sandwich shop, and it protects you from another Subway opening up right next to you or nearby. So mergers and acquisitions, that's where companies come together, and it can happen in one of a couple of ways. So a merger is when two companies combine to make a new third company, okay? Oftentimes they'll do that so that they can emerge stronger than they were separately. Sometimes companies will merge with their biggest supplier, that sort of thing, or their biggest distributor. An acquisition is when one company buys another company and the old company ceases to exist. So when I sold my company, it was an acquisition. Somebody acquired my company and then my company didn't exist anymore. And I won't get into vertical, horizontal, and conglomerate. That gets fairly complicated. So I hope that was helpful to you. I look forward to speaking with you in the next lecture. Thank you.